What's up, welcome to the second free video I'm making here. This one's going to be the basics of technical analysis, so a deep dive into what makes price move. So now that you watched the first video, you know a little bit about options, futures, risk management, the stock market. Now you need to know how to implement that and how to trade, right? So how do you chart? How do you find support, resistance, trend lines, some indicators that I use. We're going to deep dive into all of that. One thing I want to say before we start, I want you guys to be writing this stuff down. That is the best way to retain the information. If you're not writing it down, it's going to go in one ear and then out the other within 2-3 hours. So write this stuff down, and that way you can go over it. And we're going to have quizzes at the end of each module, so you can go over it. You can go back in your notes and you could read what each slide said, and you can really retain the information. So make sure you're writing this stuff down. Here's the course outline for today. We have, now you could I split this up into 5 days again. You don't have to do 5 different days. You can do it all in one if you want. You could do it in 2. This is just a little outline. If you do want to follow this, cool. If not, cool, right? Module 1 is going to be the building blocks. So it's candlesticks and the basics. What is technical analysis? The core philosophy of technical analysis. Intro to candlesticks, candlestick anatomy, practice candlestick reading, and then we're going to take that quiz. Module 2 is going to be trends, supply, and demand. So understanding trends, drawing trend lines, supply and demand, support and resistance, and then you're going to take that Module 2 quiz. Module 3 is chart patterns and candlestick formations. So we're going to candlestick formations. We're going to practice identifying those formations. Then we're going to chart patterns, and we're going to practice identifying chart patterns. So this course is going to be a lot of practice. There's going to be a lot of visual practices in this course. And we're going to take that Module 3 quiz after. Day 4 is going to be indicators and volume price analysis. So introduction to volume, how and when to use volume, EMAs, exponential moving averages, and relative strength index. And we're going to take that Module 4 quiz. And the last thing is the final exam. So this is going to be a quicker video than the first video. It's going to be a little bit more straightforward. It's going to be very easy for you guys to follow. The last one might have been a little bit confusing as a beginner, but this, I think you guys will get a better understanding, and I made it more visual for my visual learners out there. I'm a visual learner myself, so it's very visual. But let's get into Module 1. Candlesticks and the basics. Some learning objectives are define technical analysis and its core philosophy, understand why technical analysis works in the first place, identify the 4 key data points on a candlestick, differentiate between bullish and bearish candlesticks, and explain the story behind each candlestick. Each candlestick's going to represent the battle between buyers and sellers, and we want to be able to get a story behind that candlestick. Lesson 1. What is technical analysis? The definition in its simplest form, technical analysis is a method of studying past price and volume data to predict where a market might go next. So think of it like being a detective. You're looking for clues and patterns on a chart that tell you a story about what has happened, so you can make an educated guess about what's likely to happen next. Right, so what's the difference between fundamental analysts and a technical analyst? Fundamental analysts are like financial journalists. They study a company's financial reports, its management team, and the overall industry to determine its intrinsic value. So it's true value. Intrinsic means true value. They care about the why. Why is this company's stock a good buy? Now, technical analysis are more like meteorologists. We don't care why a hurricane is forming, but we want to know where it's headed. We're focused on the what. What is the price doing right now, and what does the past tell us about where it's likely to go next? So we don't care, why a stock is valued at this level, but we more so care where it's going to go next, and we use clues and hints that's already happened in the past to determine a high probability play that's likely to happen in the future. So both are valid forms of analysis, but for this course, we're going to focus on the charts, and we're going to focus on technical analysis. The core philosophy. So why does technical analysis work? This is going to help you understand why it works. Technical analysis is built on 2 core ideas. The first is that the market discounts everything. This means that all the relevant information from a company's earnings report to global economic news, it's already factored into the current price of a stock or a currency. The price itself tells you all you need to know about the current supply and demand. So if you're a fundamental analyst, you already have all that information, and the stock is already priced in all available information. So its true price is its true price. The second core idea is that history tends to repeat itself. Why? Because human behavior and market psychology are constant. Traders and investors react to fear, greed, and hope in predictable ways, and these emotions create reoccurring patterns on charts. By learning to identify these patterns, we can find high probability opportunities. Now, you guys might have heard the term past performance is not indicative of future results. While that is true, and it's not going to work 100% of the time, technical analysis gives you a high probability of it playing out. So you might have a 70% chance of it happening or 80% chance of it happening. And that's why technical analysis works. And you got to keep your losers smaller than your winners. You got to keep your losers smaller than your winners. You'll be good in the long run. Lesson 2, introducing the candlestick. It's a visual story. So candlesticks are the most important tool we have as technical analysts. Think of a candlestick as a single snapshot of a stock story. Instead of just seeing a simple line connecting one price to the next, a candlestick gives us a much richer, more detailed picture. Each candle tells us a complete story about the price action that happened over a specific period of time, whether that's a minute, an hour, a day, or a week, or a month, right? This is a huge advantage over something like a line chart, which only connects the closing prices. A line chart can hide a lot of important information while a candlestick lays it all out for you. So a candlestick really shows you in depth the battle between the buyers and sellers and who's winning at the end of that candlestick. Where a line chart, it won't tell you that. It'll just show you where you closed at, right? And then that's missing a lot of information. So what are the 4 key data points on a candlestick? The open and the close, the high and the low. So the open is the price at the very beginning of the period, and the close is the price at the very end of the period. The relationship between these two is what determines the color of a candle. What is the high and the low? The high is the highest price the stock reached during that time period, and the low is the lowest price it reached. Together, these 4 points give us a complete picture of the price action during a specific period. You can see how much higher or lower the price moved, even if it didn't stay there. If you're a little bit confused, that's okay. Once we get into some visual examples, you're going to be able to understand this very easily. So, candlestick anatomy. Let's put these 4 points on a visual chart to see how a candlestick is actually formed. Let's say these candlesticks represent a 5-minute time period. So, every 5 minutes, a new candlestick is formed. So, let's say, we had a candlestick right here where my mouse is, and it ended, and now we have the next candlestick. So we open at this price right here. This is our open price, right at the bottom of this candlestick. We went as low as here. We created a low. Then we went as high as here. We created this high, and we closed right here. So at the bottom of the body, this is your body, and these are your wicks. At the bottom is your open on a green candle, and at the top is your close. These are your wicks. And obviously, it's very self-explanatory, the high and the low. The high is going to be the high of the candlestick, the high of the wick, and the low is going to be the low of the wick. In between the open and the close is called the body, right? Vice versa with a red candle, because that means the sellers won that battle and we closed lower than where we opened at. The open will be at the top right here. We opened here. We went as high as this price. We went as low as this price. We pushed back up and we closed right here. So, once again, for a green candle, we open here, we went as low as here, created a wick, we went as high as here, created another wick, and we closed right here. So, price started here and ended here within that 5-minute time period. Vice versa for a red candle, we opened higher than where we closed at. So, the sellers won. Sellers drove that price down. So, the thick part in the middle is called the body. It represents the range between the open and the close. Is the most important part because it tells us who won the battle for that period, the buyers or the sellers. The thin lines that extend from the body are called the wicks. These show us the high and the low for the period. The upper wick shows us the highest price reached, and the lower wick shows us the lowest price reached. Like I was just saying, we'll go over it one more time just to engrave it into your guys' head. We open here at the bottom of this candlestick. Price pushed down. We created a low and a wick, and then we pushed back up. We went up. We went all the way up to this high. We created another wick, and then we closed right here. And all that happened within 5 minutes, because we're gonna say these candlesticks represent 5 minutes, right? And it could be a 1-minute chart. It could be a 5-minute, hourly, 4-hour, daily, a weekly. It doesn't matter. But for this example, I'm just saying this is 5 minutes. And then the next 5-minute candle, let's say we opened up here. We pushed up a little bit. We created a high. we push back down, we create a low, we push a little bit up, and we close right here. All right. So we have our 4 key data points is the open, the close, the high, and the low. And then you have the body is in between the open and the close, and the wicks are the wicks at the top and bottom of these candles, right? So let's practice some candlestick reading. Here's a blank image of a candlestick. I want you to write it down on your paper and then mark out 4 key data points. I want you to mark out the open, the close, the high, the low, and then also want you to mark out the body of the candle and the wicks. All right, so do that real quick, and then I'll show another example of that drawn out. This is very easy, right? Candlestick reading. All right, so now that you got that written down and you marked out your open, close, high, low, body, and the wicks, let's go back and just test yourself, see if you're right real quick. So we have the open, the close, the high, and the low. And for the red candles, the only thing that's different is where we open and close at, right? Because we're going to close lower than where we opened. And that is module 1. It was super simple. We just practiced some candlestick reading, and that's a very basic of technical analysis. We're going to dive a little bit deeper into module 2, 3, and 4. So let's take this module 1 quiz. Module 1 quiz. So it's only 3 questions, really short. I didn't want to have these long, but I just wanted to quiz you guys a little bit, so make sure you guys are paying attention. So I want you guys to read these questions and then get your answers, write them down, and then I'll provide the answers. All right, question number 1. What are the 2 core ideas that technical analysis is based on? The market discounts everything, and history tends to repeat itself. That is really why technical analysis works. Question number 2. What are the 4 key data points a candlestick provides? Super simple, right? The high, the low, the open, and the close. The open, close, high, and low. Question number 3. What do bodies and wicks represent in a candlestick? Bodies represent the range between the open and the close, and the wicks represent the highs and the lows of that period. That's the end of the quiz. It's really simple, just 3 questions. Let's go on to module 2. Module 2, the driving forces. Trends, supply, and demand. Some learning objectives. Identify and describe the 3 types of trends. Demonstrate how to draw a trend line. Explain the role of supply and demand in price movements. Define and be able to find support and resistance levels. Lesson 1, understanding trends. The overall direction. So we learned how to read a single candlestick, which is like a single word in a book. Now we're going to put those words together to read sentences and paragraphs by understanding trends. A trend is simply the general direction of a market's price over a period of time. It tells us whether buyers or sellers are winning the long-term battle. Remember this, the trend is your friend, and trade with the trend, not against it. It's going to save you from a lot of headache. So what are the 3 types of trends? An uptrend, a downtrend, and a sideways trend. An uptrend is a series of higher highs and higher lows. Imagine a staircase where each step is higher than the last. This tells us that the buyers are constantly pushing the price up, and each time the price pulls back, it doesn't fall as low as the last time. Let's look at an example of that. We have a higher high, then a higher low, then a higher high, then a higher low, higher high, higher low, higher high, higher low, higher high. So none of these lows broke below the past low. And that's a great indication that we're in an uptrend. And it's very easy, and a 2-year-old can identify a trend, but this is just giving you the basics. Now, what is a downtrend? It's the opposite of an uptrend. It's a series of lower highs and lower lows. This shows that sellers are in control, and each rally in price fails to reach the previous high. So we have a lower high, lower low, lower high, lower low, lower high, lower low, lower high. And we're just trending right down. A sideways trend is known as a consolidation or a trading range. Stay away. You don't want to be trading a sideways trend. You could, play the top and the bottom of it, but the trends are your friends, and that's where you make the most of your money is in trends. In sideways markets, it's tricky. It's better just to stay away. So your 3 types of trends: an uptrend, a downtrend, and a sideways trend. Now we're going to draw trend lines. One of the easiest ways to visualize and confirm a trend is by drawing a trend line. A trend line is simply a line connecting a series of highs or lows. For an uptrend, you draw a line connecting at least two of the lowest points for the swing lows. This line acts as a visual guide for the trend support. For a downtrend, you draw a line connecting at least two of the highest points, the swing highs. This line acts as a visual guide for the trend's resistance. The more times the price touches and respects this line, the stronger the trend is considered to be. Remember, a trend line needs at least 2 points to be considered valid. So if the trend doesn't have at least 2 lower lows or 2 higher lows, then there's no trend yet. So let's practice. I know it's hard because you guys can't actually draw on this. You can only just look. But it's very easy to use your eyes. Are we making higher highs or are we making lower highs? We're making higher highs, right? We have a higher low, higher high, higher low, higher high, higher low. And now we have yet to make a higher high or a higher low. So this can go either way. But for now, we're still in an uptrend, right? We still have yet to break this low. So until we break this low, then we start a new downtrend. But for now, we're in an uptrend. Some more practice. Are we making lower lows or are we making lower highs? Are we making lower lows or higher lows? We're making lower lows, right? Right? So we have 3 touches of this downtrend. We're clearly going down. A 2-year-old could see that we're going down, right? So trend lines are very easy. It's the simplest analysis within technical analysis. Some more practice. We're making higher highs, higher lows, or neither. We're making neither here, right? This is just a sideways channel. We're just going sideways. Can't really seem to go anywhere. So we don't really want to trade this. We want to break. We want to wait for this to break, or we want to wait for this to break, and then we can form a trade here. So we had an uptrend, a downtrend, and a sideways trend. All right. Lesson 3, supply and demand, the engine of the market. So what actually creates these trends? The answer is simple, supply and demand. This is the most fundamental concept in all of trading. It's also the most fundamental concept in the economy, right? Supply and demand. Think of the market as a big auction, because it is a big auction. When there are more people who want to buy a stock than there are people who want to sell it, demand is greater than supply. So the price will be pushed higher to find a new level where more sellers are willing to come in. This is what creates an uptrend. When there are more people who want to sell a stock than there are people who want to buy it, supply is greater than demand. So the price has to be pushed lower to find a new level where more buyers are willing to step in. This creates a downtrend. So in a downtrend, we're trying to find some demand, and in an uptrend, we're trying to find some more supply. Lesson 4, support and resistance. So supply and demand creates support and resistance levels for us traders to use, right? As the supply and demand play out, they create key price levels on a chart. The first is support. Support is a price level where a stock tends to stop falling and gets supported by a high concentration of buyers. It's like a price floor. The repeated buying at this level shows that demand is strong and many traders are willing to buy the asset at that price, preventing it from going lower. A stock may test a support level multiple times, and each time it holds, the level is considered stronger, right? So think of support as a floor. Support is a floor where price fails to go under. You can't go below the floor, right? You can't go below the ground surface. An example of support would be here. So you see we rejected it, and we got over it, and we held it twice. So this is an example of support. This is an example of where demand stepped in and we failed to go lower at this 58.5 here on CVS's daily chart. Another example of support, this one is on Centene Corporation. You see we held this level, this 25 level, we held it once, twice, 3 times, 4 times. So you see price really respects what happens in the past. So this happened all the way back in 2016, 2017, where we had this level of support. We came back and retested it in 2025, and look how well it held as support. So, you know, it could be a support level from 10 years ago, and it's still valid. You can still use it. You know, this bounced almost $8 off this. So an options contract, that might go like 200%. So you could triple your money by playing this off support. The price ceiling. So the opposite of support is resistance. Resistance is a price level where a stock tends to stop rising and it meets strong selling pressure. It's like a price ceiling. At this level, many traders are willing to sell the asset, which prevents the price from climbing higher. Support and resistance levels are simply visual representations of where supply and demand are in state of balance. The more times a level is tested, the more significant it becomes to traders. So let's look at an example of resistance. Now this is a good example of support and resistance levels being more of a zone. So not all support and resistance levels are going to be an exact level on a chart, and actually most of them are going to be zones on a chart, right? So on this example, from 45 to 49, it's a whole zone of resistance, right? Because sellers don't come in at the exact price every time, and most of the time it's not going to be an exact price. There's going to be wicks, right? We talked about wicks already. There's going to be wicks in those zones. So it's more so going to be a zone where buyers are failing to step in, and they're not buying as much at those zones. So their sellers are winning the battle, and that zone is creating supply for price to drive down lower. So in this example, we support that held twice here, almost 3 times. We failed it, came back up, retested that zone, rejected because seller stepped in, and again we came up and rejected once again. So you see this is a nice level on this AI stock here. If we get above this level, then price is likely to rise at least, $10, $20 here. It's a nice level to trade off of. Another example is this Palo Alto, this cybersecurity stock. We have this zone of resistance here. You see every time price comes up to this level, we fail it. 1 failure, 2 failures, 3 failures, 4, 5, 6, and we're attempting to come up to it again and test that zone again. So be interested to see what happens there. If we get over this level, we're likely to keep going up for a while, because now all of that supply here gets rinsed out and we got to find a new level, right? So we're likely to go higher after resistance level is broke. But until it's broke, you can't go long into this. You can't buy calls into this, right? And that's the end of module 2. Very quick modules. Like I said, it's going to be a very quick video compared to the first video we did, because this is very simple stuff. You guys should be understanding this much better than what an option and a futures contract is. It's much easier. I can teach a 10-year-old this stuff, right? Support, resistance, trend lines, very simple. So that's the end of module 2. Let's take this quiz once again. Pause this video, read these questions, get your answers, and then I'll go over them. So question number 1: what's the difference between an uptrend, downtrend, and sideways trend? An uptrend consists of higher highs and higher lows. A downtrend is the opposites, lower highs and lower lows. And a sideways trend consists of neither higher highs or higher lows. So it's just kind of going sideways, right? Explain how supply and demand create a support level. A support level is created when demand is strong enough to stop a price fall, establishing a price floor as buyers outnumber the sellers. Obviously, your words to describe this is going to be different, but as long as you have the general idea correct, you're correct. What does resistance act as, right? So support acts as a floor. What does resistance act as? A ceiling. That is the end of module 2. Let's go ahead and knock out module 3. Reading the story. So we went over the psychology of technical analysis, candlesticks, supply and demand, and trend lines. Now let's put that together a little bit more. Let's go over chart patterns and candlestick formations. So some learning objectives is explain the psychology behind key formations, learn basic candlestick formations, recognize the significance of reversal and continuation patterns, identify chart patterns and candlestick formations. Lesson 1, the psychology of patterns and formations. So before we move on to the patterns themselves, let's talk about the most fascinating part, the psychology behind them. It's not magic, it's simply a visual representation of human emotion. The whole stock market is just a visual representation of buyers and sellers and the emotions of us humans that are buying and selling, right? So what drives human emotions? What are the 2 most important emotions we have as humans? It's fear and greed. So fear drives selling. When traders are afraid of losing money, they sell. This creates downward pressure, which we see as red candles and downtrends. Greed drives buying. When traders are greedy and don't want to miss out on a rally, they buy. This creates upward pressure, which we see as green candles and uptrends. Patterns like a double top or a head and shoulders show us a market where greed is repeatedly hitting a wall of fear. When the pattern completes is a visual confirmation that fear has finally won the battle. Similarly, a continuation pattern like a bull flag shows a brief moment of fear within a dominant trend of greed. Once the pattern resolves and the price breaks out, it's a sign that the underlying greedy sentiment is still in control. By understanding the underlying emotions, you'll be able to interpret these patterns more effectively, even if you see a variation that doesn't perfectly match the textbook. So once you understand the psychology behind what moves the market, the psychology behind candlesticks and patterns, it'll help you better understand, what's going to happen next. Lesson 2, candlestick formations. Candlestick formations are small groups of candles that give us quick clues about the market sentiment. There are a ton of different formations, but I'm going to cover what works best for me and what has the highest probability of working from my experience. So the 3 best candlestick formations in my experience are bullish and bearish engulfings, bullish and bearish pin bars, and morning and evening stars. So these are all candlestick formations. Let's dive deeper into each of these. First one is going to be bullish and bearish engulfings. The engulfing pattern is a 2-candle reversal pattern where the second candle's body completely engulfs the first. A bullish engulfing happens in a downtrend. A large green candle's body completely covers the previous red candle, showing that buyers have suddenly taken control and overwhelmed the sellers. The opposite, a bearish engulfing, signals that sellers have taken over and may be starting a new downtrend. This is my number 1 probability candlestick formation. So what is this pattern? A bullish engulfing is when the body of the second candle completely, quote unquote, engulfs the previous candle. So we have the body of the previous candle. Now the next candle opens down here and we get a complete engulf of that previous candle's body, right? So that really shows that buyers have stepped up since then and we completely took out all of the sellers from the previous candle. So this shows sentiment is flipping and we might have a bottom. And to the opposite of that, a bearish engulfing is when we completely smother the bullish candle beforehand. So we're trending up, then a new candle opens and we completely engulf and we close below the body of the previous candle. So this shows that all those buyers that were coming in completely got wiped out and the sellers took control at some key level and started pushing the price down. Now we're going to go over bullish and bearish pin bars. This is my second highest probability candlestick formation. A pin bar is a candlestick with a very small body and a long wick, often at least 2 to 3 times the size of the body. The long wick signals a strong rejection of a price level. A bullish pin bar, which has a long lower wick, shows that sellers tried to push that price down, but buyers came in and pushed it all the way back up, rejecting the lower price. This is a strong bullish reversal signal, especially at a support level. The opposite is the bearish pin bar with a long upper wick, which signals a strong rejection of a higher price. So let's look at it here. The pin bar is just a one candlestick price pattern. So it just involves one candlestick. So you see this is the pin bar candle. You see we open here, we push price down, and then buyers stepped in within this time period and pushed price all the way back up higher than where we opened at. So that created a bullish pin bar. That really shows that buyers took control within that formation of the candle, whatever time frame this candlestick is. Let's call it, a daily candlestick. So we open here, we went as low as here on the day, and then we pushed price all the way back up, and buyers won that battle, left a long wick on the bottom, really signaling that a short-term bottom at least can be in here. And similarly, with a bearish pin bar, we have this long wick to the upside. So let's say this is a daily candlestick. We open here, we went as high as here. Those sellers came in, pushed the price all the way back down. They said, no, the buyers aren't winning this battle. We close here, we left a long wick ahead. That really shows that sellers are winning the battle, and the next candlestick, the next few candlesticks might be bearish, right? The sellers might continue to win that battle, at least in the short term. The last candlestick formation that we're going to cover today, and this is my third highest probability candlestick formation, is morning and evening stars. The morning and evening star are powerful 3-candle reversal patterns. A morning star happens at the bottom of a downtrend. It starts with a large bearish candle, followed by a small-bodied candle, which is the star. It finishes with a large bullish candle that closes well into the body of the first candle. This shows a transition from selling pressure to buying pressure, signaling a potential new uptrend. The evening star is the complete opposite. It's a bearish reversal pattern that happens at the top of an uptrend. So let's look down here. The morning star is a bullish signal when price is pushing down. We get a large red candle followed by a small green, followed by another big green candle. So this represents a morning star. This represents sellers are in, and then buyers take control. They flip the script, and buyers start taking control. And the opposite is the evening star. We have price pushing up. We have a pause candle almost, like pause in price. The sellers win by a little bit, and then they come in the second candle and they win that second battle, signaling a potential top in the short time frame. So now we're going to do some practice. I want you guys to look at this chart. Look at what happens at this support level, what candlestick formation forms, and look at the result of that candlestick formation. So what is this candlestick formation? I want you guys to answer this, in your head. This candlestick right here that happened at support. This is a bullish pin bar, right? Just because it's red doesn't mean it's not bullish. We opened here, we went low, buyers stepped in within this candle and pushed price all the way back up, and we closed pretty much right where we opened, right? This signaled that buyers stepped in at this support level, and now buyers could be flipping the script. And you see the result of this pin bar off of this support. We see a big move to the upside. Some more practice. What candlestick formation formed at this resistance level? So what candlestick formation is this right here? This is a bearish engulfing. So we put price. So price was pushing up, 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 up. We came up to this resistance level, and then we formed a candle that completely engulfed the body of the previous candle. So that is a bearish engulfing. You see the result of this is price push all the way back down here. Now I want to note something because this is worth noting. You see these pin bars here? These pin bars don't mean much, and you know why? Because they're not at a key support or resistance level. So only use these candlestick formations as confluence at certain support and resistance levels. Now, if they're happening in the middle of a chart, like let's say right here, you see this pin bar form, we're not at a specific level. So don't give it much value, right? We have a pin bar here, but we're not doing it off a support level, so don't give this pin bar much value. The reason we give this value and the reason we see the continuation to the downside is because we're doing it off of a resistance level. We form this bearish candlestick formation at a resistance level, so we give that formation value. We could take an entry, we could keep a stop loss above here, and we could target low of day, which is right here. And this is a beautiful trade if you took it. Now let's go over another one. We have resistance at 179.35, price pushed up, and then we formed a candlestick formation. What is this candlestick formation? I want you guys to answer that. This is a evening star. Remember, it's a 3 candlestick formation. We have the first candle is a big bullish candle. We come up into resistance, we reject that resistance, and we form another bearish candle, and that is a evening star pattern. You see the result of that is price moves down, 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 down. And actually came back up and then created a bearish engulfing here and moved down again. So you see this is a nice double top, this is a nice resistance, and you see the evening star formation right here. Last one we're going to go over is this one right here. We have a support zone at 758 to 758.5 here on Meta. What is this candlestick formation right here? This is a bullish pin bar. So we have a bullish pin bar off a key support, and you see the result of that. We trend higher the rest of the day. Oh, another one, more practice. We have support level right here at 229 on Apple. What happens right here? We form a bullish engulfing. Nice bullish engulfing, and you see the result of this is price shoots straight up into that next resistance level. Another one, this is the opposite of the evening star. This is going to be the morning star. So we get a big red candle we push right into support. This candle is almost like a pause candle, and then we follow it up by a big bullish candle here, and we form a morning star pattern. You see the result of this is price pushes up the rest of the day on Amazon. Now, this is super important. I made a quick note earlier, but confluences are key. You should never trade a candlestick formation on its own, right? Don't give a candlestick formation value if it's not at a support or resistance level. The power of these patterns comes from confluence. Confluence simply means that multiple signals are pointing to the same conclusion. For example, a bullish pin bar is a nice signal, but is just a candle. It becomes a powerful signal when it forms at a major support zone on high volume after the RSI has entered the oversold zone. So we'll go over we haven't gone over volume or RSI yet, but those are more confluences, and the more confluences, the better. So in that case, you have 4 signals all pointing to the same idea. Demand is winning the battle at that particular price. So as we move on to chart patterns, always remember that you're building a case. The more evidence you have from candles, patterns, volume, and indicators, the stronger your case becomes. So if you're a detective and you find this guy's shoe, that's all you have. But if you find his shoe, then you get his DNA, and you find his glasses, and then you have him on camera. You have all these confluences, and you got your guy, right? So the more confluences, the better. Lesson 3, chart patterns. Now let's zoom out and look at the larger formations, which is chart patterns. These tell a bigger story about a potential trend reversal or continuation. So these chart patterns are better on like 4-hour time frames, daily time frames, weekly time frames. But you can use them intraday as well. You can use them on 5-minute time frames as well. But they're better, they're a higher probability on daily and weekly time frames. So once again, there are a ton of different patterns, but I'm going to cover what works best for me and what has the highest probability of working from my experience. Number 1 is bull and bear flags. Number 2 is double top and double bottoms. We have head and shoulders and inverse head and shoulders, and rising and falling wedges. So let's dive into each of these. So bull and bear flags. These patterns suggest that a trend is simply taking a break before continuing in the same direction. These are continuation patterns, as in a pattern that suggests continuation in the larger time frame trend. It looks just like a flag on a flagpole. The flagpole is a sharp price move, and the flag is a small sloping consolidation. When the price breaks out of that flag, it's a strong signal that the original trend will continue. So let's take a look at this example. We have price push up, 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 up. Then we get a short consolidation in price, followed by a break of that consolidation, and that is the bull flag. This consolidation is considered the bull flag. We get a break of that bull flag, and you see the result should be a nice push up. And the opposite of that is a bearish flag, so it's a bear flag. We have price pushing down. We create a consolidation point. We break that. And the bear flag is broken. That gives us the confirmation that the bear flag will probably play out. We keep our stop loss here, and we target lower. So essentially, a bull and bear flag is price taking a break and a consolidation before moving in that same direction. Double top and double bottoms. Double top and double bottom are key reversal patterns. A double top forms when price hits the resistance level twice and then falls, signaling a strong reversal. A double bottom is the opposite, forming when price hits a support level twice and then rallies. So let's say we have a support level here on the chart. Price comes down, holds that support, comes down again, holds it again. Now we form a double bottom. Once we break that high we made here, that is confirmation that the pattern will probably play out, and we could take a long trade targeting some price higher than the next resistance. Opposite is the double top. So we come up into resistance, we reject it, come down lower, come up again, reject that price again. So sellers are strong at that resistance and buyers are strong at this support. So we have this floor here and we have this ceiling here, creating a double bottom and a double top. Now we can also have triple bottoms and triple tops when we hold that level 3 times or hold this top 3 times. Now we have head and shoulders and inverse head and shoulders. The head and shoulders pattern is one of the most famous reversal signals. It has a middle peak that is higher than the 2 surrounding peaks. The line connecting the lows is called the neckline, and the price breaks below this neckline is a strong signal of a reversal. The inverted head and shoulders is a bullish counterpart, signaling a reversal from a downtrend to an uptrend. So let's go over these. Head and shoulders. We have an uptrend, we form a left shoulder, we come down, we come back up, we form a head, come down again, come back up, form a right shoulder, and then we get a breakout. These would be a lot better to understand when we go over to the visual representations. Just hang in with me. Now the inverse head and shoulder is the complete opposite. We're within a downtrend and we form a bottom, and it's a good signal that the downtrend is over and we're going to start a new uptrend. Right, so we're in a downtrend, we come down, create a left shoulder, come down again, a head, right shoulder, and then we break out. All right, now the last patterns that we're going over is rising and falling wedges. Sorry about this picture, this is very blurry, but just, hang in there with me. A rising wedge is a bearish reversal pattern that forms as price makes higher highs and higher lows within a tightening range. This shows that the buying momentum is weakening, signaling potential reversal. A falling wedge is the opposite. It's a bullish reversal pattern. So a rising wedge is when price consolidates and quote-unquote wedge, creates higher highs and higher lows, and eventually breaks down from this trend line, and it's a bearish reversal pattern. Falling wedge is the opposite. It's a bullish reversal pattern. We get lower lows and lower highs, eventually break out of this pattern and continue a new uptrend. So now let's practice identifying some chart patterns. So I want you guys to look at this chart and try to identify a chart pattern on this chart. This is going to be a inverse head and shoulders. I know it's a lot easier once I put the drawing up for you guys to see it, but after a while, you'll look at so many charts and you'll chart so many times that you're going to pull up this chart and you're going to see it within 5 seconds, right? So to make this video, I had to find all these patterns and I find all these charts. So I'm just going back in the past and charting some stocks. So I had to try to find inverse head and shoulders pattern. I went to this in the videos. I went to the video chart. I found this data. I went to the daily chart and I found this within 10 seconds. Right? I've been doing this for 3 years. So I chart patterns and it's like this. Right? It comes to me very easy. I see bull flags, bear flags, rising wedges, falling wedges, head and shoulders. All these chart patterns, double top, double bottoms. I see it very easily, and it'll come to you guys very easily. Just keep charting and keep practicing, right? So let's dive into this. We have the left shoulder here. Price pushed back down. We created the head. Back up, back down, and we created the right shoulder. So we have left shoulder, head, right shoulder. This is our neckline. Once we break this, we can take our entry, and you see the result of this on the video chart. It just went up, 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 up. All right, so that was the inverse head and shoulders. So more practice, try to find a pattern here on C3AI stock. So pause this video and find a pattern. So this is an easy one, right? Maybe you guys got this. This is a double top. We created 2 rejects at this resistance level, forming a double top. Let's go to the next one. This is similar to a double top. That's my hint. You guys should be able to find this one. We created a double bottom, and this could even be a triple bottom using this low as well. So we have a low, and then another low. You can say it's a triple bottom, and you see the result of us holding the support level. We came higher. Let's look at Coinbase. This one, I'm gonna give you a hint. It's right in the middle of your screen. This is a bull flag, right? So we found a bottom, we started trending up, we got a short consolidation here, boom, 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 boom. We broke out of this bull flag, and you see the result of that. We came higher. We actually formed new all-time highs here on Coinbase. Another one, this is going to be similar to that first one we went over, right? So that's my hint on this one. There's actually 2 patterns here that I can see, almost 3. So what do we have here? We have another inverse head and shoulders. We have our left shoulder, our head, and our right shoulder. And then, to give you even more confluence, within this right shoulder, we have a falling wedge, right? You guys remember falling wedge? We have a lower high, a lower low, lower high, lower low. We're forming this wedge, and it's a right shoulder. So this is a very high probability play. And I actually got this on shares back in 2024. I caught this play. MMM is trading way higher now, but at the very bottom of MMM's price, this is the company MMM, we formed the inverse head and shoulders and a falling wedge. Another one on Wingstop. This is another flag. That's my hint. Just try to find where it's at. Right here in the middle of your screen, we have this bull flag that formed. We have price going up, consolidate, and continue to go up after that bull flag broke out. Now we have Dollar General. This is a wedge pattern. I'll tell you that. This is a wedge pattern. Just find out where that wedge pattern is. All right. This is the wedge here. We have a lower high, lower low, lower high, lower low. We're forming these. Once we break that trend line, you see a little bit of manipulation here, but ultimately this pattern did play out, and we saw this was the bottom on Dollar General. Now we have another wedge. That's my hint. Just try to find out where this wedge is on SPY's weekly chart. We have it right here. You see this wedge where price is kind of wedged in between. Once we broke down, you see the results. We had a nice sell-off of a couple days on SPY. And that is it. That is all the practice. We're on the Module 3 quiz. So I'll pause this video, get your answers, and I'll go over them. Number 1, what is the highest probability candlestick formation? So we went over these. Go back in your notes. What is the highest probability? The engulfing formation, right? The bullish and bearish engulfings. What does a bullish pin bar suggest about the interaction between buyers and sellers? So what story does it tell us about buyers and sellers? Buyers took control at some point during the formation of the candle, right? So the candlestick opened, we pushed down, buyers stepped in within that candle, pushed price back up, and we closed with that long wick at the bottom, right? That shows buyers took control. A morning star pattern is considered what type of signal? So is it a bullish signal or a bearish signal? It's a bullish signal. And we are on to Module 4. That was quick. We're getting right through this. I hope you guys are learning a lot. I hope you guys are retaining this information. Once again, I hope you guys are writing this stuff down. Module 4, the tools. So this is the last module. We're going to go over indicators and volume. So some learning objectives are understand the role of volume as a confirmation tool, describe the function and common uses of the EMA, the exponential moving average, interpret the relative strength index, the RSI, and synthesize analysis from both indicators and price action. Lesson 1, the importance of volume. Volume is simply the number of shares or contracts that have been traded during a given period. It tells us how much interest there is in a price move. Think of it as the power behind the punch. A big price move with high volume is like a powerful knockout punch. It's a strong, convincing move. A big price move with low volume, however, is like a flimsy punch. It might look good, but there's no power behind it. It's a sign of weakness, and it's often not a reliable signal, right? So if you're seeing price push up, and there's no volume behind the price, that means there's not a lot of volume. There's not a lot of buyers pushing that price up. So that be careful and be wary that might reject at some point and come back down. And likewise with the downtrend, if we're trending down and these candles don't have much volume behind it, that means there's not much sellers, there's not much interest in this downtrend, and we might create a bottom sometime soon. So how and when to use volume. Think of a breakout. A breakout is when the price moves strongly above resistance or below support. High volume on a breakout. This is a very strong signal. It shows that many traders are participating in the move, confirming that the new trend is likely to be sustainable. So when we break a level on very high volume, that shows that buyers are willing to buy the price above that resistance level. So it's a strong indication that it'll continue in that direction. Low volume on a breakout. Now this is a warning sign. It suggests that the price move is not backed by strong conviction from traders and could easily fail or reverse. So let's look at some examples. So some low volume breakout examples. We have this breakout on TSM, Taiwan Semiconductors. We have this breakout of 262. But you see how little this volume is compared to the previous candles on the breakout. This shows that not many buyers are interested in buying above 262, and you see the results of it. The sellers step in, we form a bearish engulfing, and we fail this 262 level. Same thing with strategy here at this 321 level. We broke below it, but the volume was very little compared to these previous candles. And you see the results of this. The buyers stepped back in, and we held that level. Now, some high volume breakout examples we have here on Amazon. You see how high this volume is on this breakout of 223? Very, very high volume here. And the result of it is continued buying above that level. And likewise on MU, you see this high, very, very high volume breakout above 120.2 on MU. Look at this volume compared to all these other candles. This volume was very high, and you see the result of that. The buyers are still interested above this level, and the breakout sustains. So lesson 2, the EMA, exponential moving average. This is another indicator I use. The exponential moving average, or EMA, this is a line that plots the average price over a certain period, but it's designed to give you more weight to recent prices. This makes it more reactive to new information than a simple moving average. So how can you use it? The most common way is to identify the overall trend. If the price is consistently trading above the EMA, the trend is considered bullish. If the price is consistently trading below the EMA, the trend is considered bearish. So let's look at some examples. So here's an example on Tesla stock. You see how well this orange line is the EMA. You see how well the price holds this EMA as we're in an uptrend. It just holds it. Every time we touch it, we go higher, higher. You know, and likewise on Goldman Sachs, you see this orange line here. We got every time we kind of failed to go below that. So it's nice to use as kind of as a dynamic support, right? Instead of just having a support line sideways on a chart, it kind of follows the price up, and it's good to use when we have strong trends. Lesson 3, Relative Strength Index, the RSI. The Relative Strength Index, or RSI, is a momentum oscillator. It's a line that moves between 0 and 100 and tells us whether a stock is overbought or oversold. If the RSI crosses above 70, the asset is considered overbought. This doesn't mean you should automatically sell, but it does suggest that the rally is running out of steam and a pullback or reversal may be coming. If the RSI drops below 30, the asset is considered oversold. This suggests the price has fallen too far, too fast, and a bounce might be coming. The RSI is a great tool for confirming your analysis. For example, if you see a double top pattern on a chart and the RSI is in the overbought zone, it strengthens your belief that a reversal is coming. Remember, these are confluences. None should be considered as a trade on its own, but you put all of these together, now you have a great trade, right? If we're at a support zone and then we form a double bottom and the RSI is oversold and we form a bullish engulfing, you have everything together, then that is a great indication. It's like a 95% chance that we're going to go higher from that level. So use confluences. Let's look at some examples. You see on Boeing Company that price goes really far above this 70 zone, which indicates very overbought, and the result of that is a nice sell-off. And vice versa on Crowd, we have the RSI becoming very low, and that means the stock is very oversold, and you see a nice rally. Now, bullish and bearish divergence. This is personally my favorite thing to take swing trades off of when we have like bullish divergence into a key support level, right? So let's dive into this. A bullish divergence is a reversal signal that appears in a downtrend. It happens when the price makes a lower low, but the RSI makes a higher low. The price is still going down, but the indicator is showing that the selling momentum is weakening. This is a strong hint that the downtrend is running out of steam and a potential reversal to the upside is coming. Now, the opposite of bullish divergence is bearish divergence. It's a reversal signal that appears in an uptrend. It happens when the price makes a higher high, but the indicator makes a lower high. The price is still going up, but the indicator shows that the buy momentum is weakening. This is a classic warning sign that the uptrend may be losing its strength and a reversal to the downside is imminent. So let's look at some examples of this. So we have a bullish divergence example. You see on this chart, we make a lower low. So we make a new low. This low is lower than this low. But on the RSI, this low right here is higher than this low. So we have divergence, hence the name, right? This is bullish divergence because the chart makes a new low and the RSI fails to make a low. This is the highest probability setup in the market, in my experience, right? And especially if you combine that with a key support level and a good solid company, that stock is going to bounce at 95% of the time, right? So we have a new low created on the chart and a higher low created on the RSI. That forms divergence, and that is called bullish divergence. The result of this is upside on C3AI stock. Now the opposite would be bearish divergence. You see the chart is making higher highs, but the RSI is making lower highs, right? So we're making a new high on the chart and lower highs on the RSI indicator. So this indicates that the selling is running out of steam, and you see the result of it is a big sell-off. So we're going to practice some divergence examples now. What is happening here? Is this bullish divergence or is this bearish divergence? And why? So this is bearish divergence. You see, we make new highs on the chart, but the RSI is making lower highs. This indicates that the buying is starting to fade, and you see the result of this is big sell-offs here on Avis budget group stock. Some more divergence practice. So I want you guys to identify where the bullish divergence is on this chart. Exactly, it's right here. See, the chart makes a new low. So we broke this low, we made a new low, but the RSI, it makes a higher low. So this is divergence. This shows that the selling pressure is weakening and a reversal is probably coming, right? So this is bullish divergence. We make a new low on the chart, a higher low on the RSI indicator, and you see the result of this is a nice upside move. Remember, divergence is a warning signal, not a direct trade signal. You should never buy or sell based on divergence alone. Instead, wait for other forms of influence, like a break of a trend line or a candlestick formation, to confirm the signal before you enter a trade. This will help you avoid false signals and increase your probability of a successful trade. Like I keep saying, confluences. They are everything. The more confluences, the better. Don't take a trade because of one signal, right? You want 3 or 4 signals, and, at least 2 signals to take a trade. Minimum 2 signals, but the more the better. You had 4 or 5 signals, you have the very, very high probability trade. And that's the end of the last module. Now we have this module 4 quiz and then the final exam. And the final exam is a lot of charts, and I want to nail you guys with charts. I want to nail this in your head so you remember these patterns, these formations, and bullish and bearish divergence. All of these, we have tons of examples that I found on charts for you guys to look at, and you can watch this video again if you want some reminders. So that'll be at the end. So first we have this module 4 quiz. So pause this video, get your answers, and then we'll go over them. Number 1, explain the difference between a high volume breakout and a low volume breakout. A high volume breakout is much more likely to continue in that direction than a low volume breakout, right? Because we have lots and lots of buyers behind that move. Number 2, if a stock's price is consistently trading below its 9-day EMA, exponential moving average, what might that indicate about its trend? Then we're probably in a downtrend, right? Number 3, what is the significance of the 70 and 30 levels on the RSI? If the RSI is above 70, the stock is considered overbought and is considered oversold if the RSI is under 30. That is the end of the course. That was quick. I hope you guys really found this course useful. I put this all up for free, so the least y'all can do is drop a like for me, subscribe. I really appreciate it. I want you guys to really be great traders. I've been a full-time trader for a year now, and it's incredible the freedom I get. I get time freedom, location freedom, and financial freedom, and that's what we look for as humans. We don't want to be stuck at a 9-to-5 job. That's probably why you're watching this course right now. So 4 days ago, you might have not known the difference between a support and resistance line. Now you have a solid foundation for reading charts like a pro. So a quick recap is the basics. You've learned that candlesticks are the fundamental building blocks of price action, telling you a quick story about who's in control. You got the big picture. You now understand that trends are the overall direction of the market, driven by the core forces of supply and demand, which create support and resistance levels. You now understand the story behind the charts. You've learned to read the more complex story on a chart by identifying candlestick formations and chart patterns, and you understand the psychology behind them. That's the most important part. And you got some tools. You've learned how to use volume and some key indicators like the EMA and the RSI to confirm your analysis and find high probability trade setups. You are now equipped with the essential tools to analyze any chart. The next step is to put all this knowledge to the test in the final exam. So let's move on to the final exam. This is where we bring everything we've learned over the past 4 days together into comprehensive exercises. The goal of this final exam is not to get a perfect score, but it's to test your ability to look at a raw chart and start building a narrative from all of the clues that it's giving you. So draw this candlestick on your page, mark out the open, close, high, low, body, and wicks. We've already done this once. This should be very easy. And here's their answers. Alright, so first thing we're going to go over is trends. So I want you guys to look at this chart and identify at least 3 trends on this chart. It could be 3 uptrends, 3 downtrends, 3 sideways trends, or 3 all different. It doesn't matter. Just identify 3 trends on this chart, and then I'll show you what I have. Right, so we have a downtrend followed by an uptrend, and a sideways trend, then a very short uptrend followed by a downtrend. Create bullish divergence. I don't have the RSI up, but I remember this. We did create bullish divergence. Then we started another uptrend followed by a downtrend, and we actually just broke that downtrend, starting to create a new uptrend. So that's trends for you. Now the next thing is support and resistance. So I want you guys to look at this chart. Once again, I know it's hard because you can't actually put these lines on your chart, but just try to identify some support and resistance levels. You know, some very easy ones for you are the highs and the lows, right? Those should be very easy support and resistance levels for you guys. But pause this video, try to find some. So this is what I have. I know it looks like a lot, but let's go over these, right? Let's start from the top. Let's start from the bottom and go up. So you have this support level here. We bounce on it once, twice, 3, 4, 5 times. So a big support level here at the low of this chart. Then we have this level that we rejected here twice, got back over it, and then it turned into support. So resistance flipped into support. And you'll see that a lot on charts. You'll see resistance flip into support and support flip into resistance. And those are nice levels to take a trade off of. So you have this key level right here. You have another zone at 142. We attempted to hold it and failed it. And then we held it here and held it here. And so we formed a double bottom off this level. We have another level at 209. We held it after IPO. Then we flipped that support, turned it into resistance here. We held it again here and here. We flipped that once again, turned it into resistance, turned it into resistance once again, and then we got that breakout. The next level is 273. You see we rejected it here. We got back over it. We rejected it again once we got back below. Rejected it. Kind of chopped through it, but rejected it again. Then we broke out of it. Next level will be 350. Rejected it shortly after IPO. Rejected it again here. We broke it, turned it into support. Got to move higher. Broke back below it, and then turned that into resistance here. And the last level will be, you know, the IPO high, and then we rejected it once again back here. So very clean support and resistance levels here on Coinbase. Now we're gonna go over some candlestick formations. I want you guys to tell me what candlestick formation is this right here. Easy one. That's right. It's a bearish engulfing. What is this? Bullish pin bar. And this one, a little bit more difficult, maybe. It is a morning star pattern, right? It's a bullish pattern. All right, now we're moving on to chart patterns. So what chart pattern is in the middle of the screen right here for you guys? It's an easy one. I think we actually already covered this in one of the practice ones. This is a bull flag, right? So you get that flagpole, flag, and then breakout. This is another pattern. It's right in the middle of your screen. It might be a little hard to see, but you know, once I have these lines, you'll be like, oh yeah. Yep, it's a falling wedge. So we broke out of that. We did have help from earnings, but we broke out of this falling wedge and we got a big move up. This one has two of the same pattern on this chart. Maybe you guys can see it both. Maybe you guys a few seconds. This is two rising wedges. So you see this wedge here, it broke down, got a nice move. We got another rising wedge here, we broke down, consolidated, and then got a big drop. Here's another pattern formation. It's another inverse head and shoulder. So you have the left shoulder, the head, and the right shoulder. Now for this one, you have three of the same pattern. And this is my #1 probability chart pattern. We have three bear flags. Bear flag, also call this a rising wedge, but rising wedge is typically when the first leg is a leg up. In this case, we already have a flag pull, so this is why it's a bear flag. So you have bear flag, drop, another bear flag, drop, another bear flag, drop. So when a stock is downtrending and these flags form, they're very easy to catch. You just gotta wait for the break. So this candle right here is your entry. This candle right here is your entry. I know it's a huge fucking candle. Maybe you catch it mid candle, right? And then this candle right here is your entry. You write it down to this zone we have. Now this is another chart pattern. I'm not gonna give you that hint actually. Try to find this chart pattern here. It's in the middle of your chart. This is a regular head and shoulders, right? You could also call this a bear flag as well. So you have the left shoulder, the head, and the right shoulder. You can also call this a bear flag. This candle right here is your entry. Stop above that candle high. And you see the results of that. So this one is going to be a volume example. So remember we talked about how volume impacts breakouts. Now I want you guys to look at the volume and look at this breakout and determine and tell me, what do you think will happen? Do you think this will continue, or do you think we'll snap back higher based on the volume of the break? Now it will continue, right? Because we have high volume on this break. You see this volume is a lot higher than all these other candles before it. So we have a high volume of participants in this breakdown. You see the results of that is a nice sell-off. Now another one. Judging based on the volume of this breakdown, what do you think will happen next? Complete reversal. And you know why? Because this volume right here is very little. Look at this red candle. It's smaller than all the other candles besides the one right before it. So it's very little volume, not a lot of participants in this breakdown. So we instantly snap back up, and we got a nice turnaround. So this example kind of involves everything. It involves a support level, the EMA, and the volume. I want you guys to put together these clues that it's giving you to determine where price is going to go next. If you guessed up, you are correct. And I'll tell you why. We have resistance that flips. Remember what I told you. Resistance usually flips and turns into support. So you have resistance that flip turns to support. You have high volume. Look at this volume on this candle here. On the breakout, you have high volume compared to all these other candles. You have a very low volume pullback. So not a lot of sellers are participating in this move down. And you have a pullback to that resistance that is now turning into support. And also this EMA, right? We talked about this EMA can act as a dynamic support zone in a trend. And you can clearly see we are trending up. So that acted as support as well. You see the result of this. So you can buy this right here, stop below that level, and you see the result. It's a nice push up. Another example, you have a downtrend. You have this EMA. Where do you think this will go next? The trend is your friend. It continues lower. And look at how this EMA acts as a dynamic resistance, right? And look at these volume. Look at the volume. I want you guys to recognize this volume. You see this sell-off volume, very high. It's rising. Each candle getting more and more. Then you have a low volume bullish candle followed by more rising volume on the selling. So rising, rising, rising. You have another pullback, very low volume on the green candles, right? You have a big reject with high volume, more low volume green candles, and this just continues to trend down. Now we're gonna look at a divergence example. So based on the RSI and based on the chart, what do you think will happen next? If you guys down, you were right, because we have, what is this called? We have a lower high on the RSI and a higher high on the chart. What does that indicate, and what is this called? This indicates that buying is becoming weaker, right? There's less buyers in this uptrend, and we formed a bearish divergence, which is a selling signal. Now, sorry about this image, it's the only way I can get it, but just focus on this right here. So based on this ending and based on the RSI, what do you think will happen next? If you guess we will bounce, you are correct. Big bounce here on block, on SQ, right? We have, actually it's called XYZ, this indicator now, but we have bullish divergence. We may have a higher low on the RSI, but a lower low on the chart. This indicates that this selling and the downtrend is weakening. There's not a lot of sellers participating in this sell-off anymore, and we create bullish divergence and we fly from this level. Now, another example of volume on a breakout. Now, based on this volume, on this breakout, what do you think will happen next? If you guess continuation, you are correct, because look at this volume. Let's go back. Look at this volume compared to the previous candles. Much more participants in the market as we're breaking down this level. And the result of that is a nice sell-off. Now, this example is kind of putting a lot of different things together. We have support that turns into resistance that is going to turn into what? We also have the EMA coming up here. We have pretty high volume, right? So all that, what do you think was going to happen next? We went higher, right? Because we have this EMA acting as support. We have resistance, that we have support turn into resistance that now flipped again and turned to support. We have a little bull flag, if you want to call this a bull flag, right? We have high volume right here on this candle, indicating a reversal. So a lot of different things there, and you see the reclaim. Now here, based on what you see on the chart, what do you think will happen next? Well, we have support that turns into resistance. So we have support that turned into resistance. We also have this EMA that acts as a dynamic resistance in a downtrend, right? And we also have a very high volume. Look at this volume on this candle, very high on this breakdown, right? Which indicates continuation. And that is it. That is all the examples I have. I hope that was enough. If not, hop on tradingview.com. It is free, and just chart. You guys, eventually it'll become, second nature. You look at a chart and be like, boom, double top. Boom, this is going to continue. Boom, this. It'll come second nature, and it'll become intuition. So that's the end of the course. You have went from a beginner to an analyst. You now understand what makes price move, how to read the story on a chart, and how to use key tools to confirm your analysis. This knowledge gives you a serious edge. You're no longer just guessing. You're using evidence to build a case for every trading decision that you make. Remember, confluence is king. The more signals that line up, from a strong candlestick formation to a confirming indicator, the higher your probability of success. It's time to apply what you've learned. Start building your case, analyze with confidence, and let those charts tell you their story. What's next? Now, just like in my previous video, I'm just going to include this at the end. Once again, I did not make this video to try to pull you guys into my Discord. I honestly, genuinely just want you guys to get the basics down. I want you guys to learn this. I can't give you the rest for free. I just work way too hard on all of that other stuff to give it to you for free. I put, over 100 hours on these two courses alone, and I gave it to you guys for free. I really hope it all helped. But the next video is going to be Discord VIP access only. But I do have a free version of the Discord. We'll do some free lessons over there, risk management, psychology, every now and then. So you'll get these full video courses. Obviously, they'll be up on my YouTube. You'll get certain live classes, some free live classes in the free version. You'll get a motivation and insights channel, right? Just to help you get motivation when you're not feeling it. We'll show some gains in there every once in a while, stuff like that. You'll get to see the trading chat. You'll get to see our paid members, what they're talking about, some ideas that they're gonna go over. You're gonna see some long-term ideas. Now this is really, really valuable. We're gonna send out what we like in the long term. The long term is really where the big money is made, right? Day trading gets that steady cash flow, but most of that cash flow is gonna be put into long-term investments. You won't be getting the daily watch list, the live day trading signals, swing trading signals, access to our trading strategy, access to VIP exclusive live classes and Q&As, and you won't have the ability to engage in the trading chat channel. But if you do want to join the VIP version, which by the way is cheaper than almost any Discord out there that's giving trading signals, especially at the high win rate that we're giving. Once again, I did not make this video for you guys to join, but if you want that value, if you want to take the extra step in your journey, you know, it's very cheap compared to all the competitors that are out there. The price will be under Get Access channel in our free Discord, so join the free Discord and then you'll see that price for the paid Discord. You'll have daily watch lists, live day trading signals, swing trading signals, full breakdown of our trading strategy, exclusive live classes, direct Q&As, trading chat, and everything in the free version. So it is jam-packed with value. We're here to help. Once again, like I said in the previous video, you can say, you know, if I'm making so much money trading, why am I charging for a course? And why am I selling a course? Because you have all these course sellers selling now. Well, 75% of these course sellers are selling, but they have no clue what the fuck they're doing. All their money is coming from the course. The difference between them and us, we make money day trading. And we genuinely want to help you guys make money. We want to elevate your trading. We want to give you guys a good start. That's why I give a 5-step walkthrough for you guys to know nothing and get started day trading within a week if you want to. If you really sat down to follow those 5 steps, you can start day trading in 1 week. I'm not promising you're going to make any money. It's very, very fucking hard. That's why 95% of traders fail. But that stat is so high because 95% of day traders quit, right? They quit within 6 months. They quit within a year. This is not a get-rich-quick scheme, but over the long run, you will make money. I lost money for my first 2 years, right? I got up every single day and lost money for the first 2 years. My 3rd year, which is the year I'm on, I'm actually over 3 years now. I'm into my 4th year, but I am highly profitable now. I am full-time. I don't have any other job. I wake up, I get on the charts at 8 o'clock. I'm done by 11. My full work day is over. You know, I make anywhere from $100 to $1,000 in a single day, and that's only going to get bigger and bigger as I up my size. So it is very possible, and I'm here as a testimony to you guys that want to make this happen. I promise you, you can make this happen, right? And then you can use these trading profits. Trading shouldn't be your only goal. You should use your trading profits to build other businesses, to buy real estate, right? To buy long-term investments. That's what day trading is for, because day trading is risky, right? It is. It's not steady cash flow, but it can be if you are profitable. So I am here to try to make every single one of you guys that are watching this profitable traders. If you're interested in that, you can join that VIP access version. Once again, that is not what I'm here to preach though. I'm not here to just try to get you in my paid Discord. So if you want to just join that free one, get that free value from me, feel free to. I will be happy to see you guys in there. Thank you for watching this video. Peace out.